Having reached the appointed time, I call the second meeting of the Capital Investment Committee to order. Representative Swazinski, would you like to move the approval of the minutes?
I would. I'd like to move the minutes last meeting.
Thank you. So approved. Today we have a presentation by nonpartisan staff. It's kind of bonding 101 for those of you who have not been in bonding before. It's new. For those of you that have been here before, it's a chance to review your knowledge base. We have two of our very able staff people presenting. I consulted with them before the meeting started, and they are happy to take questions during their presentation. So if you have a question of the presenters, please get my attention, and I will be happy to interrupt their presentation and get your questions answered. So with that, will you please identify yourself for the record?
Thank you, Mr. Chair. My name is, what?
You don't know?
Oh.
Come on,
Excuse me. Thank you, Mr. Chair. My name is Deb Dyson. I'm from the House Research Department.
My name is Andrew Lee. I'm from the House Fiscal Office.
Thank you very much, and welcome to the Capital Investment Committee.
Happy to be here. Mr. Chair and members, we were asked to provide an overview of capital investment and state bonding this afternoon, and I'm hoping that in your folders there's a copy of the information brief that looks like this, the capital investment and state bonding that was just revised a little bit and updated. That's more detailed information, and much of my part of the presentation is taken from that information brief. To start with a definition over, to start, bonds, municipal bonds are debt securities issued by states, cities, counties, and other governmental entities. They're issued to finance capital projects such as buildings, roads, sewers, and in Minnesota for local governments, it can also be day-to-day obligations. The issuer agrees to repay the bondholders the principal with interest in the time specified. Bonds are often described in different ways. Sometimes they're described by the issuer, whether it's a state bond, a municipality, or a special district. Sometimes they're described based on the purpose for which the bonds are issued. You'll hear them called transportation bonds, building bonds, sewer bonds. The state issues the largest part of bond sales that the state issues are often called various purpose bonds, and then within the issuing statement, it'll list all the different projects that are included in them. Sometimes the bonds are described by the source of payment, general obligation or revenue bonds. Sometimes it's a maturity structure, the price, tax status, tax exempt, taxable bonds, the rates, the terms. For the authority for issuing bonds by the state is found in the state constitution. Article 11, section 4 and 5 for the general obligation bonds. There's nothing in the Constitution that talks about revenue bonds, and the state issues those based on state statute. The state statutes that are primarily involved in bond issuance are found in Minnesota Statutes, Chapter 16A. And then the federal law is involved in the state's issuance of tax-exempt bonds, and that's where the rules governing issuance of tax-exempt bonds comes from, is federal tax law. Focusing in on what is probably the bulk of the work of this committee, general obligation bonds, the state constitution spells out that the bonds must be issued for a public purpose, same as all state spending. The bonds must be issued for a purpose that's authorized in the Constitution. And the state constitution lists purposes for which the bonds can be issued, and GO bonds cannot be issued for purposes that are not included in this list. In Article 11, Section 4 of the state constitution, it says the state may contract public debts for which its full faith, credit, and taxing powers may be pledged at the times and in the manner authorized by law, but only for the purposes and subject to the conditions stated in Section 5. Public debt includes any obligation payable directly in whole or in part from a tax of statewide application on any class of property, income, transaction, or privilege, but does not include any obligation which is payable from revenues other than taxes. The next provision in the Constitution governing state general obligation bonds is that the law authorizing the bonds must be specific. And this means that either the appropriation rider has to say it's for this building project in this location, or it has to be appropriated to a statutory program that provides for how the money will be spent. And then finally, all state general obligation bonds mature in no more than 20 years under the Constitution. And then the last point that's a little bit separate talks about that bonding bills originate in the House. And you might think of the bonding bill as a spending bill, but because general obligation bonds are backed by the full faith and credit of the state, and the Constitution provides an unlimited statewide property tax that will be levied to pay off the bonds if there's no appropriation or inadequate funds from the general fund to pay the debt service, which is where debt service typically comes from. Bond counsel says it would not be unreasonable for a court to determine that it's a bill to raise revenue because of that constitutional dedication of a property tax. So general obligation bonds, in the view of state bond counsel, could be deemed, the bill authorizing them could be deemed to be a bill to raise revenue, and therefore the bill must originate in the House.
I have a question, if you don't mind, Ms. Dyson. So if I recall correctly, last year, there was not a bill introduced in the Senate. Is that correct?
Mr. Chair, there was a Senate bonding bill.
There was. Okay. Maybe I'm
I recall.
misremembering. But but there was not a conference committee, as I recall, was there?
No conference committee.
So is that unusual, or is that something we might expect to happen again, or have you no idea?
Mr. Chair, I would not say things can't happen again. Is it unusual? I think it is unusual not to have a conference committee, but it has happened. And so that's a hard one to answer.
Yeah, well, we don't give you easy questions. All right, very good, thank you.
Sure. As I mentioned, the bulk of the work of the committee relates to general obligation bonds that are issued to acquire and better public lands and buildings. This is in Article 11, Section 5, Paragraph A of the Constitution. And that's where you have the requirement that, or the authorization for the state to issue debt to pay for capital projects that are publicly owned and that require a 3/5 vote of both the House and the Senate. With regard to capital projects, in general, a capital project is to acquire and improve fixed assets such as land or buildings. It has to be long-lived. Bond counsel has suggested that the useful life be at least 10 years. The improvements have to be substantial, for example, extend the useful life or substantially increase the value of a fixed asset. They're not predictable, recurring, the way repairs would be. And another example of what a capital project is or isn't, a study or planning is not capital in nature because the way it's viewed is that that's looking to see if something should be done. It hasn't been decided that it should be done and where it should be done. Publicly owned. Bond counsel has advised that publicly owned means owned by the state or a political subdivision of the state. So that you'll find that projects, there are projects that are administered by a nonprofit, but they're not owned by a nonprofit. So for example, you have some major facilities such as the Science Museum of Minnesota. It's owned by the city of St. Paul. It's run under a contract with the foundation that, the nonprofit that runs the Science Museum. And then the 3/5 vote of the body, that's self-explanatory. The state constitution has other paragraphs in that same section that authorize the use of general obligation bonds. On the slide, you'll see that it lists those other paragraphs and then the date that they were added to the Constitution. You have the repel invasion or suppress insurrection from 1857, temporary borrowing through certificates of indebtedness since 1962, which is also when the Constitution was amended to authorize general obligation bonds that we're mostly talking about here.
Ms. Dyson, I
Yeah.
believe we have another question. Representative Hansen?
Thank you, Mr. Chair. And Ms. Dyson, I wanted to go back to the public ownership and again, asking a question about one of the projects from last year. There was a water system in southwestern Minnesota that I think was a 2-state or a 3-state thing, and it was or was not partially publicly owned. Can you maybe just highlight how that was bondable or what happened with that?
Mr. Chair and Representative Hansen, I think you're referring to the Lewis and Clark rural water system, and the proposal was not for any portion of a project that was outside of the state of Minnesota. You're correct, that is a multi-state water supply project. So it was all within the state. There was, at the beginning of session, it was included in the bonding bill part of the capital investment bill because the understanding originally was that it was publicly owned. Close to the end of session, it became unclear and that public ownership part, and it became very, I guess I'll say a little messy there at the end. And so it was switched from bonding to cash. And so that was not a bonded project. That's a cash project.
Representative Hansen?
Thank you, Mr. Chair. And so just that, we thought it was thought to be publicly owned, but it wasn't. So then it was cash, the cash bill, the separate bill that was not general obligation bonds. And so we really can't be doing any bonding for that project in the future, right?
Mr. Chair, Representative Hansen, I don't want to say that it can't be done in the future under the conditions that were existing at that time. No, I don't think so. But it's when you have projects that are that complex with different governance structures and ownership of different systems, I think it's important to consult with the MMB staff and the experts on the ownership structure and understanding what is being purchased and who owns it. So in the past, it may have, one element of a project may be a water tower owned by a city. That's public ownership. It's within the state. It's a fixed asset. But as I said, things were too uncertain at the end of last session, and it appeared that it was not publicly owned or would not remain publicly owned, that it was not intended that it remain publicly owned. So it was changed to cash to make it clear that it would work, but I don't want to weigh in on how something would be financed or structured in the future.
Representative Hansen?
And just a final question, has any of that cash been used?
Ms. Dyson?
Mr. Chair and Representative Hansen, I'd have to check with the agency. I don't know.
Thank you. Representative Uglin?
Thank you, Mr. Chair. Ms. Dyson, a question a little bit about bonding for public land and stuff. Have there ever been any bonding bills to improve public waters? I know that there's other sources of funding for that too, but for improvements to, say, municipal public waters, areas, ponds, other things like that?
Ms. Dyson?
Mr. Chair and Representative Uglin, if I understand what you're referring to, yes, watershed projects have been funded.
Okay. That's exactly what I was looking for. Thank you, Mr. Chair.
Thank you, Representative. Representative O'Driscoll.
Thank you, Mr. Chair. To just ping off a little bit what Representative Hanson was saying with Ms. Dyson's comments, my understanding, if I can try to simplify this just a bit, there was a valid joint powers agreement between the different states and entities with that Lewis and Clark line. The disqualifier was that none of the participants could meet the definition of a political subdivision created by the state of Minnesota. Is my simplification and recollection pretty accurate on that?
Ms. Dyson.
Mr. Chair and Representative O'Driscoll, I think so, except that, in my view, that goes back to about 2008, when there was an issue of the joint powers agreement between the states and the ownership, and there was a point where some money had been switched back and forth on that. But last year, I think the problem also had to do with a stated public owner that actually wasn't intending to remain the owner, that they were going to transfer it to a non-eligible entity. I'm a little iffy on this one because it was pretty late in the session.
Very good. I would like to let members know that we are going to have a hearing specifically on Lewis and Clark, and we will have a chance to delve into the details of both what happened last year and what may or may not happen this year. Representative Hausman.
Thank you, Mr. Chair. And what I would suggest then is that you would also include Mr. Freeman from the PFA, because I think it was, we're all sitting around a table thinking we have no problem, and as I recall, it was Mr. Freeman from PFA who said something that as they looked at it, why it wouldn't have qualified, and we suddenly all thought, does that mean it's not publicly owned? It was too close to the end of session, and so since we were having a cash bill anyway, it was easy to do that, but since he was the one, as I recall, sitting around the table who made that, some statement that made us all call this into question, I would think if you're having the hearing that we'd make certain that he was in the room.
Thank you, Representative Hausman. That's one of the reasons we're having the hearing, is to make sure that we're all very clear about what happened with that project and make sure that we've kind of cleared the deck for possible action on that project in the future. Representative Vogel.
Thank you, Mr. Chair. Ms. Dyson, just curious on those other constitutionally authorized, does that mean the Constitution was actually amended to allow those things in those years? Or was it like a reinterpretation of the?
Ms. Dyson.
Mr. Chair and Representative Vogel, yeah, the dates in the parentheses refer to the year in which the Constitution was amended to specifically list those as eligible. So, there are other ways to pay for capital projects besides general obligation bonds. As we've talked about, there's the general fund. Revenue bonds for projects that actually would have revenues to pay off the bonds. And the revenues would have to be revenues that are not a tax of statewide application, because that would turn them into general obligation bonds. There are the appropriation bonds. These are bonds that do not have the backing of the full faith and credit of the state. They are payable from a statutory or standing appropriation of general fund money. The examples for those you probably remember from 2011, using appropriation bonds to refund the tobacco securitization bonds that were originally issued to pay down the debt service for a biennium on outstanding debt, and that was a way of balancing the budget that year. Appropriation bonds have also been used for the Viking Stadium. Agency bonds payable from standing appropriations. For that, you have as examples the MHFA nonprofit housing bonds and the housing infrastructure bonds. There's the University of Minnesota Biomedical Science Research Facilities and the Gopher Stadium. Lease purchase financing for equipment. There's a master lease program in statute that was established to do that, and I'm not as familiar with that, so if you have questions about the equipment financing lease purchase, that would be a good question for MMB. And lease purchase financing for real estate. And then finally, there are credit enhancement programs in statute that provide a backing for local government, for school district and city and county debt, so that they can get a better rating and on their bonds as they're issued. But the local governments are ultimately the ones that would have to pay off that debt, even if the state were to step in and help. And I don't know if that's ever been used, but the credit enhancement program is there.
Ms. Dyson, if I could
Yes.
interrupt you for a moment. You know, one of the other topics that I intend to explore in this committee is the financing of the new Senate office building. Did that fit into this lease purchase financing for real estate or not?
Mr. Chair, yes.
Thank you. And if you could just back up to the slide before this for a moment. I notice there's a line there to develop the state's agricultural resources by extending credit on real estate. I'm in the process of buying a farm, and I'm wondering if you can help me out.
Mr. Chair, this provision relates to the Rural Finance Authority and the various loan programs administered through that. So if you qualify under the statute for the loan programs in the RFA, this is where the money goes or comes from for that program.
Thank you. And for the benefit of anyone listening, I was kidding. I was not serious. Thank you. You can go on.
I wanted to mention capital appropriation cancellations. This was originally enacted in 1995. Before that, capital appropriations did not lapse, but every now and then the legislature and then the Department of Finance would go through capital appropriations that hadn't been, that for projects that were completed or that were not going to be used, and go through and cancel those in the bill. In 1995, this law was enacted to provide a set mechanism for basically cleaning up the outstanding authorizations and appropriations that have not been used or are no longer needed. So January 1st of every odd-numbered year, this year, the Department of Management and Budget reports on cancellation of general fund and bond financed projects that are authorized that are more than 4 years, that were authorized more than 4 years before January 1st. And then the unobligated, unencumbered, or unspent project balances in the report are canceled effective July 1st unless the legislature reauthorizes them in the law. So 1995 was when this was originally enacted. It was 7 years. In 1997, it was changed to a 5-year cycle, and in 2000, it was moved to 4 years to sort of push projects along. So when you look at past bonding bills, you'll often, I always call it the back of the bill stuff, but the beginning of the bill are the new appropriations and riders, and then the bond sale authorization, changes to statute, and then there, towards the back, there are amendments to existing laws, previously enacted appropriations for projects, and a fairly common amendment now is to extend the authority for money to be used for a project that is still in the works but has not used the money yet, and so to allow them to continue with the project. And I think trails have often been a problem that way because trails require the agencies to work with landowners in getting the land transactions to take place, and that can take time to assemble the parcels, and so the 4 years sometimes isn't quite enough to wrap that up for a trail project.
Thank you. And could you just clarify the reauthorization of those bonds? Does that require a 60% vote?
Yes, Mr.
Thank you.
Chair. A couple other topics that I wanted to touch on in the overview. Reimbursement issues. This sometimes comes up where, especially in requests from local governments, primarily from them, where they want to, they're working on a capital project and they would like to get reimbursed for what they've been doing, and it is otherwise eligible. State general obligation bonds are not able to be used for reimbursement of projects that are already underway, and it relates to federal tax law. There have been instances where where the bill has has appropriated money to pay off the principal on a project. For example, in 1998, the Minneapolis Convention Center was appropriated money to pay off principal on outstanding debt so that the city could issue new debt to expand the convention center. And apparently under federal tax law, that's acceptable. But in general, no reimbursement. And if that's something that your local governments want to look into, it's something that has to be looked at by MMB and bond counsel before before pursuing it. I'm not an expert on the federal tax law issues related to this, but that's one of those areas where you want to really look at it before you start going down that path. The role of bond counsel, you've heard me refer to bond counsel says any number of times. The state attorney general is bond counsel for the state, and they also retain outside bond counsel, particularly for use in evaluating the federal and state tax implications of the bonds, so that they can provide an opinion to potential buyers of bonds on the tax status of the bonds and the legality of the bonds. That means that a lot of our guidance on what is bondable and what is not bondable comes from the bond counsel, because you don't really get to the court system if nobody will buy the bonds so you don't have the very much in terms of court opinions on how to interpret this, because you just never get there. If bond counsel won't give you a good opinion on the legality or tax status of the bonds, nobody will buy them, and then there's no way to challenge it. So bond counsel plays a very important role in determining what the legislature can do in terms of appropriating money from the bond proceeds fund. Use of state bond finance property is another issue that comes up fairly often, particularly in grants to political subdivisions and their arrangements with nonprofit organizations. There is a statute that was enacted back in 1994 to address a lot of that, and it always seems to come up in terms of, can we transfer this property? Can we use it for a different purpose? Can we sell it? Who gets the proceeds of the sale if it's sold? Those are all governed by the statute that governs use of state bond finance property. Non-state match requirements. For grants to political subdivisions, there's a statute that says that it's assumed that the appropriation is for 50% of the cost of the project. Sometimes the legislature appropriates the full amount, sometimes not. There's a push to make it clear in every rider that whether or not it's a 50% or not, or how much of this is for that, covering that project. But no matter what the rider says, the appropriation, if it's not enough to complete the project, they won't see any of the money unless all of the money is available from some source to complete it. As bond counsel has said, we don't build half a building. You have to do the project or not. And so there's another statute that says that all money must be available to complete the project before any of it is released. And then the last thing I wanted to touch on before letting Andy talk about, Mr. Lee talk about the money, is just a brief comparison of state and local bonding, because a fair number of people have experience with local bonding and then say, why can't the state? And the basic thing is that the state has limitations that local governments don't. The state is limited by the state constitution as to what purposes can be, what bonds can be used for, and local governments are regulated by statute. And so, for example, local bonding, the default position for local general obligation debt is that there has to be a referendum. The state does not have a referendum. The state statutes put limits on local government debt, and sometimes you'll see the local government laws that say outside of debt or outside of net debt limits. So you end up seeing bills that address those issues. The state does not have a debt limit. And as Mr. Lee will talk about, there are debt guidelines, but there is no limit. Public ownership is another one of those. As I mentioned earlier, state GO bond finance projects have to be publicly owned. Local government projects have to have a public purpose, but they do not have to be publicly owned. And then the various purposes. The purposes are whatever the state authorizes. So, and the Constitution limits the state purposes.
Ms. Dyson, if
Yeah.
we could backtrack for just a moment. So you talked about bond counsel. I assume that there's some costs incurred hiring bond counsel. Where do those costs, who pays?
Mr. Chair, the bond counsel is retained by the Attorney General's office, I believe. And then I think I'd have to check how the budget works, but I think that MMB, it's out of MMB's budget, but the fees for bond counsel are limited in statute based on an hourly rate based on expertise and time. It's not a percentage of the bond sale,
Thank you.
which sometimes in other
Representative
situations it
Hausman.
is, but it's not a percentage of the bond sale.
Thank you. Representative Hausman.
Thank you, Mr. Chair. And just to clarify something you said about no reimbursement compared to the non-state match requirements, what you can specify is some of the things the local governments have done before a project happened, that those all could count as, so we're not reimbursing them, but they could count as the non-state match. Would that be?
Ms.
Right.
Dyson.
Mr. Chair and Representative Hausman, yes, we've done that before. We've said money that has been expended by a local government or towards this project up to this point counts as the match. And, you know, for example, a local government may have already acquired the land and now they are seeking the bond grant to build the building on land that they paid for. They're separate aspects of the project, but the legislature can decide that, yes, that is equals the match, and therefore the entire amount for the building is the bond appropriation. So.
Representative Erdahl.
Thank you, Mr. Chairman and Ms. Dyson. I just want to be clear on something when you're talking about public ownership and purpose. If a project is privately owned but has a public purpose, is it bondable?
Mr. Chair and Representative
Dyson.
Erdahl, no.
I didn't think so. I just want to be clear on that. Thank you.
I just wanted to mention that state bond issuers include the Department of Management and Budget for the various purpose bonds. You also have the Housing Finance Agency, University of Minnesota, the Public Facilities Authority, Higher Education Facilities Authority. This slide lists the Tobacco Securitization Authority, but they are now no longer there since the bonds have been, the authority may be there, but there's no reason for them since those bonds have been refunded. Office of Higher Education, the Ag and Economic Development Board, the Minnesota State Colleges and Universities, the Rural Finance Authority, and the State Armory Building Commission.
Ms. Dyson, how are the bonding limits established for those various entities?
Mr. Chair, the MHFA has Mortgage Revenue Bonding Authority in their statute, and I think it says in statute what it may be in terms of outstanding balance. I would have to look at that again. The University of Minnesota, I think that's under their control. I don't think that's addressed in statute in terms of their GO bonding authority. The others are all established in statute.
Thank you.
And that concludes my portion of the presentation. Mr. Lee has the rest.
Thank you, Ms. Dyson. If there's no other questions for Ms. Dyson, we'll continue to Mr. Lee.
Thank you, Mr. Chair and members. Again, for the record, my name is Andrew Lee from House Fiscal staff. I will be covering the capital investment guidelines and also walk through a few of the spreadsheets that are used in this committee. So the capital investment guidelines, as Ms. Dyson alluded to earlier, are not a constitutional or statutory requirement. They are a policy developed by MMB, and they can also be changed by MMB. And it would require no action of the legislature for MMB to do so. There's three elements of it. The first guideline is the second bullet point on this slide, that total tax supported principal outstanding debt shall be 3.25% or less of total state personal income. And what that practically means is that the total principal that the state is paying debt service on cannot exceed 3.25% of state personal income, which is all the income in the state combined, and that's a number that is estimated by MMB. And the second guideline is inclusive of all of the principal outstanding that the state's currently paying debt on, but also includes other debts and bonds that have been authorized but haven't been issued yet. So if the legislature authorized $1 billion in general obligation bonding, but only 200 million of those bonds had been issued, there'd still be 800 million that would be in the guideline 2 category as the authorized but unissued. And that percentage is a little bit higher, 6% of state personal income. And then the third guideline is 40% of GO debt must be due within 5 years and 70% within 10 years. And essentially what this means is that the state pays a little bit more in principal on debt and a little bit less on interest because the bonds tend to mature a little bit faster than, say, a traditional 30-year fixed-rate mortgage. The current guidelines were instituted in 2009, replacing the 3% guideline. And that was a guideline that restricted the amount of debt service that can go towards general obligation debt, whereas the current guideline is a restriction on the total principal amount. So essentially, the old guideline was a restriction based on how much we pay to service the debt, and the new guideline is more broadly encompassing the total amount. And the 3% was 3% of the state general fund. The new guidelines also incorporated general obligation debt with trunk highway debt obligations, which weren't included in the 3% guideline, and other debt obligations of the general fund. So that would include appropriation bonds such as the Viking Stadium, the tobacco securitization bonds, and U of M bonds. So state personal income and debt capacity estimated by MMB as of the November 2014 debt capacity report, which comes out with the November forecast, there was 686 million in that guideline. So that's the difference between 3.25% of state personal income and how much principal outstanding debt already exists. And I actually have a table that breaks this out. If you look in your packet, that's a small table that says November 2014 principal debt in guideline 1. And you can see the various components of that, with general obligation debt being the largest at about 6.5 billion, appropriation bonds at about 1.5 billion, and then other real estate and other debts at about 234. And then, so from that, on line 22, you see the estimated state personal income that 272 billion, and what 3.25% of that is, and then so you basically subtract line 23 from line 21, and you get the debt capacity.
Thank you, Mr. Lee. I believe Representative Albright has a question.
Thank you, Mr. Chair. Mr. Lee, and I may be skipping ahead, but I'm looking at the November 2014 principal debt in guideline number 1. And I'm just wondering if you might elaborate for, you identify 6.4 in general obligation debt. How is that broken out between GO and trunk highway?
Mr. Lee.
Mr. Chair and members, I'll have to get back to you on that one. I was not able to get those numbers at the time of the committee, but I can find that out.
Mr. Chair?
Representative Albright.
Thank you, Mr. Chair. Mr. Lee, when MMB goes about making assessment or the estimate for the total debt that could be incurred by the state through GOs, is that date specific or is that on an autopilot with an inflator?
Mr. Lee.
Mr. Chair and Representative Albright, this is date specific, so this number is static. It is just a point in time number at the time of the November forecast. This is the total amount of principal outstanding, and this is the estimated state personal income, so it is point in time.
Thank you, Mr. Chair.
Oh, I'm sorry, Representative Hanson.
Thank you, Mr. Chair. And to go on this trunk highway and various purpose debt. So if the GO various purpose debt goes up, that reduces the amount of trunk highway debt that's possible because they're bundled together in the 3% limit. Or if we go up on the trunk highway, that reduces the amount of general obligation. Is that?
Mr. Lee.
Mr. Chair and members, that is correct. Both are counted towards the 1% guideline. And I should also maybe mention that trunk highway debt can be authorized by a simple majority of a body.
Mr. Lee, you mentioned that this is a guideline. How well have we done as a state in adhering to the guideline in the past?
Mr. Chair and members, this guideline, which was instituted in 2009, has not been broken, neither the three guidelines. I do believe the third guideline, MMB, gets to be within a little bit of the requiring maturity of GO bonds. I think it's a little close. I will say, however, that the old guideline, the 3% of state general fund revenue, part of the reason for the change in guidelines is because the state was about to hit that 3% guideline in 2009.
Representative Albright.
Thank you. Mr. Lee, your comments about the debt limits, to what degree does bond counsel involve themselves in guidance in terms of the level of indebtedness for the state, and does it impair or impact our credit rating itself to the extent that we intrude or breach that 3.25%?
Mr. Chair and Representative Albright, bond counsel does not have a role in creating the guidelines. That is kind of something that, from my understanding, and you might want to ask MMB this when they come to testify, that's something that MMB goes to bond houses and kind of negotiates with them.
Mr. Albright. Representative Albright.
Thank you, Mr. Chair. Mr. Lee, then it would be my understanding that bond counsel is not associated with bond house itself, or is the underwriting of the bonds subservient to one or the other?
Mr. Lee or Ms. Dyson.
Mr. Chair and Representative Albright, when we've been talking about bond counsel, we're talking about the state attorney general and then the attorneys that are retained by the state to give opinion on the tax status of the bonds and the legality for issuing them. I don't believe that they have a role in looking at the state's performance relative to debt management guidelines. The underwriters have their attorneys, but I've never heard anybody talk about the bond counsel having a role relative to the debt guidelines.
Representative Albright.
And I think the vernacular that I'm looking at here is from a standpoint of the rating agencies. That's where I come from in terms of bond counsel, not counsel that would be, in a sense, hired or that authority delegated by the AG to make opinion on the veracity of the bonds themselves, but I'm kind of driving at is, to what extent do the bond houses give guidance to council in terms of direction, in terms of what is the upper limit, or to what extent it would affect our credit rating if we breached through the 3.25%?
Dyson.
What integration between those two entities do we observe?
Ms. Dyson.
Mr. Chair and Representative Albright, I don't think that, I don't have any background on that, and I know that the commissioner and the assistant commissioner are going to be testifying next week, and the assistant commissioner for debt management, and I think that would be a question best answered by them.
Thank you, Mr. Chair.
Representative Hausman.
Thank you, Mr. Chair. And it is an interesting exercise, and we probably should get it for this committee sometime to see what the rating agencies say, all three of them, Fitch, Standard & Poor, Moody's, and what they say positively about us, and because we've always stayed within those guidelines, what they say positively to us is they have guidelines. And so that's, I think that's how they would measure. Interestingly, when they give us the rating, they really don't care about what the guideline is, and they even make just a comment about we have low to medium debt compared to other states, so that's always been positive. What they care about is, do we balance our budget well and honestly? During those years when we were shifting, they didn't like that, and it takes a while for them to get their trust back in us, and they don't like political intransigence. I mean, it's a very interesting exercise to just read those three reports, and they're very similar in terms of how they view us. So it might be another agenda item sometime.
Well, thank you, Representative. Mr. Lee, go ahead.
Mr. Chair and members, and moving on from the handout back to the slides, I do note in bold that this Debt Guideline 1 capacity is not advice to the legislature of how large a bonding bill can be. This number is kind of a lagging indicator of all of the debt that is authorized and is been issued and the state is currently paying on. So it's a lagging indicator. So in other words, the legislature could authorize a bill that is much larger than this figure and not hit the limit, at least not immediately or possibly ever. Or the flip side of that is that if there's a lot of debt that has already been authorized and the legislature authorizes a bill, a general obligation bonding bill that is smaller than this figure, and all of the previous debt is suddenly issued, or there's a downturn in the economy that depresses state personal income, the legislature could, or the state could exceed that limit. So
Mr. Lee, would it be safe to say that these are moving targets?
that, Mr. Chair, members, that would be a characterization.
Thank
Oh, and I should just also note, guideline capacity to, as of the November forecast, was 4.7 billion. Mr. Chair and members, I'll go through a few other committee accounts quickly. As I noted earlier, trunk highway debt service is not included in the debt service that is part of this committee's target. That's paid out of trunk highway revenue sources, and that's a transfer from the trunk highway fund to MMB to pay debt service on those debts. Capital projects are also paid out of the capital investment committee account. Capital projects can include appropriation bonds or, as was done in the last legislative session, the cash bill. And now I would like to just briefly walk you through two spreadsheets that I prepared for committee. The first looks like this. It's a long list. This is the capital investment list, and what I did was I pulled together the past 3 capital investment bills. So the 2013 bill, which you'll see nothing on the first few pages, and then on page 2, there's 20 million for flood mitigation. but the lion's share of that was on page 2, line 92 and 93. That was the capital renovation and capital parking area user finance bonds that were authorized. So that was the 2013 bill, and then you can see in the 2014 bill all of those amounts. And the 2014 bill is split out into two parts, the general obligation bonding piece and the cash piece. That's a good bill. So then, members, the next spreadsheet is a single page one. It looks a little bit like this. It is the capital investment committee spending, and this breaks out the debt service spending on general obligation debt and the various appropriation bonds. And I have it going back from the 2012-2013 biennium, the current biennium, the base, and the planning biennium. And I will note, Ms. Dyson mentioned earlier, if you look at line 14, you can see the tobacco securitization debt service reduction that was part of the budget in the 2011 session. So effectively, issuing those tobacco securitization bonds reduced the amount of kind of artificially reduced debt service for that biennium. So it makes it look like it grew a lot more, but that is an effect of that one-time mechanism. And then on line 6, you can see the state appropriation refunding bonds. That's the mechanism with which the state is paying back that debt. So you can see it being about $114 million a biennium. And unlike general obligation debt, appropriation bond debt does not have to be sold off within X much within 5 years and X much within 10 years. Those tend to be longer term debts, 25 to 30 years. And I'll just make one more note on this spreadsheet. General obligation debt service on line 12, that's the mechanism with which the state pays back the general obligation debt. You'll see a box that says base assumes $220 million in bonding in 2015 session and $800 million in 2016 session. That is not MMB telling the legislature that it should pass a bill that big. That's just the number that MMB uses to estimate what debt service will be in future years. So if the legislature does not pass a bill this session, that debt service will be a bit less.
Thank you, Mr. Lee. Has NMB picked out the projects they want in those two bills, or?
Mr. Chair, I don't think so.
Oh, okay. Thank you.
And with that, I think we will stand for any questions.
Thank you, Mr. Lee. And Ms. Dyson, are there any other questions for the testifiers today? Seeing none, I believe that completes our agenda. Thanks to both of you for a fine job of presenting the information today. And this committee stands adjourned.